You think you're submitting a document to the VA, maybe a few pay stubs, perhaps a Schedule C form, and that's the end of it, right? You believe the process is paper-based, slow, and that if your reported income looks reasonable enough on that single application, you're in the clear. That is the first and most dangerous misconception veterans make when dealing with federal benefits eligibility. The truth is, the moment you submit any application to the Department of Veterans Affairs that involves financial need, eligibility for specific healthcare services, or dependency claims, you're activating a massive interconnected digital audit system. This isn't just about looking at one piece of paper. This is about automated cross-referencing with nearly every other federal and state agency that holds your financial data. We are talking about data matching that happens in milliseconds, designed specifically to detect what they call inconsistent income across various reporting periods and multiple agencies. If your income reported to the VA doesn't precisely align with what the IRS, Social Security Administration, or even your state unemployment office has on file, a digital flag goes up, and that flag initiates a review that can lead to benefit delays, demands for repayment, or worse. Today, we are pulling back the curtain on the 7 core mechanisms the VA uses to detect these discrepancies, showing you exactly where the gaps in your financial reporting might be and why transparency is the only viable strategy. The absolute foundation of the VA's detection system, the mechanism that catches the vast majority of discrepancies, is the mandatory continuous data sharing agreement they have with the Internal Revenue Service and the Social Security Administration. This is not a manual process where someone sends a request for your tax returns. This is an automated, secure digital gateway that allows the VA's computer systems to pull specific financial data points almost instantly, particularly during eligibility checks and annual reviews. Think of it as a constant background conversation happening between massive government servers. The VA is primarily interested in 3 specific data sets here: W-2 forms, 1099 forms, and Schedule C filings. If you received a W-2 from an employer, the IRS has it, and therefore the VA can access the total reported wages. If you are a gig worker, a freelancer, or run a small side business, the 1099 forms, the 1099 NEC for non-employee compensation, the 1099 MISC, or the increasingly common 1099-K for payment processor transactions, are all logged. The VA system compares the total income you reported on your VA benefit application, whether for pension, aid, and attendance, or specific healthcare financial tests, directly against the cumulative total of these federally reported forms. The comparison is brutal in its simplicity. If you report $30,000 in annual income to the VA, but the IRS data match shows $45,000 in combined W-2 and 1099 income, the system doesn't just ignore the difference. It immediately calculates the deviation, flags it as a high-risk inconsistency, and queues the file for a manual audit by a financial reviewer. This automated process is designed to eliminate human error and subjective judgment. It's a purely mathematical check. It doesn't care if you forgot about a small $1,099 from a short contract job you did 6 months ago. The system sees the number, sees the mismatch, and triggers the alarm. This foundational cross-check is the first line of defense against inconsistent reporting, and because the IRS and SSA data are often delayed by a few months, meaning the VA is comparing your current reported income against the most recently filed tax year, it often reveals patterns of underreporting that span years, leading to significant clawbacks or adjustments to benefits received. Understanding this primary data match is essential because it sets the baseline for everything else the VA investigates. They know what you earned before you even tell them what you earned. Your application is simply a confirmation or denial of the existing federal data. But the VA doesn't stop at the federal level. The next layer of detection involves comprehensive cross-verification with state-level agencies, specifically those dealing with employment, unemployment insurance, and public assistance programs. Many veterans might think their state unemployment claim or their temporary assistance application is completely separate from their federal VA file. That assumption is fundamentally incorrect. Due to various federal mandates and interstate data sharing agreements, state agencies frequently communicate with federal databases, and the VA leverages this connectivity to check for inconsistencies in employment status and income streams. Consider, for instance, a veteran applying for a VA benefit that requires them to demonstrate low or no current employment income. If that veteran simultaneously filed 4 state unemployment benefits during the same period, the state unemployment office is reporting weekly or biweekly income payments to a federal clearinghouse. The VA's system accesses this clearinghouse. If the veteran reports 0 income to the VA but is receiving $500 a week in state unemployment, that is a direct, undeniable contradiction that the system flags instantly. It's not just the monetary value, it's the underlying narrative. Claiming to the VA that you are unable to work or are earning minimal income while simultaneously claiming to the state that you were laid off and are actively seeking work and receiving benefits for it creates a major inconsistency in your employment status history that the VA views with extreme skepticism. Furthermore, state welfare programs like SNAP, food assistance, or TANF, cash assistance, also require detailed income reporting. These state applications often require recent bank statements or detailed pay information that the VA might not request directly. When the VA conducts its cross-check, if the income reported on the state application is significantly higher than the income reported to the VA for the same period, it suggests deliberate underreporting on the VA side. This layer of state cross-verification is particularly effective because state systems often capture real-time, current income data, whereas the IRS data match might lag. This real-time snapshot capability makes it difficult for veterans who are actively trying to manage multiple low-income claims across different agencies simultaneously. The VA uses this state-level data as a crucial secondary check to ensure that the employment and income narrative you are presenting is consistent across all government interactions, federal and local. Any discrepancy here signals a serious risk of intentional misrepresentation, triggering an immediate and thorough investigation into all financial claims made to the VA. The third, and arguably most sophisticated mechanism the VA employs is the use of automated flagging systems and predictive analytics. This moves beyond simple data matching and into the realm of behavioral economics and statistical modeling. The VA utilizes proprietary algorithms designed to search not just for direct contradictions, but for statistically improbable financial behavior. These systems are constantly running in the background, analyzing the entire population of benefit recipients. What are these algorithms looking for? They are searching for percentile deviations. For example, if you live in a high cost of living area like San Diego or Northern Virginia, and you report an annual income of $15,000, the system automatically assigns a higher risk score to your file, simply because the historical data suggests that. Sustaining life in that zip code requires a significantly higher income floor. The algorithm doesn't assume fraud, but it flags the file as an outlier. Similarly, the system tracks historical reporting. If a veteran reported a consistent income of $40,000 for 5 years and then suddenly reports $5,000 the following year without a corresponding, verifiable major life event, like a documented medical crisis or formal disability approval, the system flags the sudden sharp drop as statistically inconsistent. The algorithm is designed to identify patterns that defy normal economic reality. It looks for things like sporadic employment that never quite adds up to the reported annual income, or bank account activity that shows large, unexplained deposits that don't correspond to the reported sources of income. These deposits might be gifts, loans, or cash payments, but if they inflate your actual spending power above the reported income level, the algorithm flags the lifestyle inconsistency. This predictive analytics approach is crucial because it anticipates fraud before a direct data match even confirms it. It creates a risk profile for every beneficiary. Files that score high on the risk profile due to sudden income drops, geographic anomalies, or statistically unlikely financial stability at low reported incomes are automatically pushed to the top of the manual review queue. This means the VA isn't wasting time manually reviewing every file. They are letting the computers identify the most probable cases of inconsistent reporting, making the audit process incredibly efficient and targeted. This is why attempting to game the system with minor adjustments is often futile. The algorithm is not looking at the raw number, it's looking at the pattern and the context of that number against millions of other data points. Moving deeper into the intricacies of detection, the fourth critical mechanism focuses specifically on the challenges posed by the modern economy. The hidden business income check, scrutinizing self-employment, independent contracting, and the explosive growth of the gig economy. For veterans who operate their own businesses, whether it's a full-time consultancy or a side hustle selling items online, the complexity of reporting income increases exponentially, and so does the VA's scrutiny. When reporting income for benefits purposes, veterans often focus only on their net profit, what's left after expenses. However, the VA is keenly aware that self-employed individuals sometimes inflate expenses or run personal costs through the business to artificially lower their taxable income, which subsequently lowers their reported income for benefit eligibility. The VA uses the IRS Schedule C filings as the primary tool here. They don't just look at line 31, net profit. They analyze the entire Schedule C, looking specifically at the gross receipts, line 1. If a veteran reports $100,000 in gross receipts but claims $95,000 in expenses, leading to a reported net profit of only $5,000, the VA system flags this disproportionately high expense ratio, especially if the expenses seem vague or unusually high for the reported type of business. They know that while this might be permissible for tax purposes, it often masks actual spending power. Furthermore, the rise of platforms like Etsy, eBay, Amazon FBA, Uber, and DoorDash means that many veterans receive income reported via 1099-K forms, which track payments processed through third-party networks. These 1099-K forms often capture the gross transaction volume, not the net profit after platform fees and cost of goods sold. The VA's automated system pulls this gross 1099-K data and compares it to the Schedule C net income. If a veteran receives $50,000 in 1,999-K payments but only reports $10,000 in net income, the system flags the massive discrepancy between the reported gross revenue stream and the reported final income for benefits eligibility. This is not necessarily proof of fraud, but it is a massive red flag indicating inconsistent reporting or highly aggressive expense deductions that warrant a detailed manual review. The VA wants to ensure that the income reported for benefits accurately reflects the financial resources available to the veteran and their household, and the complex nature of self-employment income makes this a prime area for detection and auditing, requiring veterans to be meticulously honest about the difference between tax minimization and benefits eligibility reporting. The fifth powerful detection mechanism centers on the dependency and household income test, focusing on the synchronization of financial records within the veteran's immediate family unit, particularly spousal income and dependent claims. Many VA benefits, especially pension and aid and attendance, are means-tested, meaning the financial resources of the entire household are considered, not just the veteran's income. The VA understands that a common tactic for minimizing reported household income is to strategically shift income streams or assets between spouses or dependents, or simply fail to report spousal income entirely. The VA's system performs sophisticated cross-checks using the Social Security numbers of the spouse and dependents listed on the VA application. When the VA pulls the SSA/IRS data match for the veteran, it simultaneously pulls the same data for the listed spouse. If the veteran reports zero or minimal household income, but the spousal data match reveals a substantial W-2 income or significant 1099 income, the system immediately flags the file for an audit based on omitted household resources. This is particularly relevant when a veteran claims a dependent child or an elderly parent for additional benefit allowances. The VA often checks the income sources of these claimed dependents as well, ensuring that the dependency status is genuinely based on financial need rather than simply maximizing the monthly payout. Furthermore, the VA tracks mandatory reporting requirements related to life changes, such as marriage or divorce. If a veteran reports a low income while simultaneously getting married to a high-earning individual and fails to update their marital status or report the new household income within the mandated time frame, the VA's system will eventually catch the audit marriage via SSA records or joint tax filings, triggering a retroactive review of benefits paid since the date of marriage. The key takeaway here is that when you involve family in your VA benefits claim, you are authorizing the VA to scrutinize the financial records of every person listed. The VA treats the household as a single economic unit for means-tested benefits, and any failure to synchronize the financial reporting of all members is a direct pathway to being flagged for inconsistent income. They are looking for the total economic picture, and omitting or minimizing a spouse's income is one of the quickest ways to trigger a compliance investigation. The sixth significant trigger for detecting inconsistent income is the initiation of a medical or financial hardship application audit. While the VA performs continuous automated checks, certain applications act as powerful catalysts for a deeper, manual dive into the veteran's financial history. When a veteran applies for specific high-need benefits, such as aid and attendance, A and A, or specific healthcare fee waivers based on catastrophic financial need, they are often required to fill out comprehensive financial disclosure forms, such as the VA Form 21, P-8416, Statement of Resources and Income of Claimant and Dependent. These forms require detailed information not just about current income, but about assets, investments, and expenses. The very act of submitting this detailed financial history triggers an internal audit where the VA compares the newly submitted information against every previous financial statement the veteran has ever submitted to the VA, the IRS, and the SSA. For example, if a veteran applying for A&A now reports minimal assets and low income, but 5 years ago reported owning significant investment properties or had a much higher income to qualify for a different benefit, the audit system flags the substantial change in financial status. The VA requires a verifiable, documented explanation for the depletion of assets or the drastic reduction in income. If the veteran suddenly reports selling off all their assets just before applying for A&A, the VA's financial auditors are trained to look for evidence of improper asset transfer or gifting, which is a common strategy used to qualify for means-tested benefits. The critical point is that the VA is not just looking at the present. They are comparing the present narrative against the historical record they already possess. Applying for a hardship status means you're essentially inviting the VA to conduct a deep forensic review of your entire financial timeline. If the current application for hardship is based on a level of poverty that is inconsistent with previous tax filings or asset declarations, the file is immediately flagged. These hardship audits serve as a powerful internal control mechanism, ensuring that the veteran's financial narrative remains consistent over time, and they are a primary method for uncovering long-term patterns of inconsistent income reporting. Finally, the seventh and often most unpredictable detection mechanism is the whistleblower or anonymous tip mechanism. While the VA relies heavily on automated digital systems, they also maintain formal channels for receiving information from external sources. This often comes in the form of anonymous tips, reports from disgruntled former spouses, neighbors, former employees, or even family members who have knowledge of a veteran's true financial situation. While the VA cannot take action based solely on an unverified tip, these reports serve as powerful catalysts that trigger an immediate, targeted data pull. When a tip is received, perhaps alleging that a veteran is running a large, cash-only business that is not reported on their Schedule C, or that they secretly inherited a large sum of money, the VA's compliance team doesn't just dismiss it. They use the tip as justification to initiate a deeper dive into the veteran's digital footprint. The tip provides the VA with specific keywords, dates, or addresses that the automated systems might not have initially prioritized. For instance, if a tip alleges the veteran owns a specific unregistered business, the VA can cross-reference public records, state business registrations, and utility records to corroborate the existence of the operation. If the tip alleges large, unexplained cash deposits, the VA can use the established IRS data sharing agreement to check for reports of large cash transactions filed by banks, currency transaction reports, or CTRS. The anonymous tip acts as a directional pointer, guiding the automated systems and manual reviewers to look in a specific high-probability area for inconsistent income. It moves the veteran's file from the general population audit queue to a targeted, high-priority investigation. While tips are always verified against official records before any punitive action is taken, they are a significant risk factor because they often reveal specific, non-traditional income streams or hidden assets that the broad automated checks might initially miss. Therefore, the veteran must understand that external reporting, whether motivated by malice or genuine concern, is a very real pathway for the VA to detect and verify inconsistencies in their reported financial resources. The core truth woven through all 7 of these detection mechanisms is this: the VA is not operating in a vacuum. The era of submitting a single, potentially misleading financial document and hoping for the best is long over. The Department of Veterans Affairs is fully integrated into a complex cross-agency digital ecosystem designed for continuous auditing and real-time data comparison. Whether through the foundational IRS/SSA data match, the real-time checks against state unemployment records, the predictive algorithms flagging statistical anomalies, the deep dive into complex self-employment income, the synchronization of household finances, the aggressive audits triggered by hardship claims, or the targeted investigations initiated by external tips. The system is designed to identify and flag inconsistent income reporting with remarkable efficiency. Transparency is not just recommended, it is the only viable defense against the powerful detection systems in place. Ensure that your income narrative is perfectly aligned across all federal and state reporting agencies. Understand that the VA is looking at your gross receipts, your spouse's W-2s, your bank deposit patterns, and your historical financial stability. Any attempt to minimize or omit income streams will inevitably be caught by one of these interlocking detection layers, leading to painful benefit recoupments and potential penalties. The system is designed for accuracy, and by understanding how the VA detects these inconsistencies, you can ensure that your financial reporting is always truthful, consistent, and compliant.